Hi dear traders, last trading week ended with the news that inflation in the US might have finally eased. The core personal consumption price index turned out to be lower than the previous reading and the forecast. These data definitely intensifies market expectations of the Fed ending its tightening cycle. More about how this news has affected the currency and commodities markets and what else has shaped the sentiment of traders. Watch in our video review. So the US dollar index, which demonstrates its value against the basket of 6 major currencies, managed to stabilize near the level of 102.5, having lost around 0.5% by the close of the week. It seems that investors are ready to see a pause in the Fed's rate hiking cycle, though several FOMC members have recently discussed the possibility of further tightening, even despite the crisis in the banking sector. The central bank is mainly focused on bringing high inflation down to the target of 2%. The euro-dollar pair reached a 7-week high and looks poised to continue its rally. On Friday, however, traders closed their positions on the euro to take profit at the end of the week as well as month and quarter. The major driver to push the quote up was the difference in the monetary policy of the two central banks. The European Central Bank confirmed its intention to keep the rate high in order to tackle inflation. According to preliminary estimates, consumer prices slowed down to their yearly lows in March, yet the inflation rate is still far from its 2% target. Meanwhile, the British pound managed to hit a 2-month high in the course of the previous weekly session. Inflation in the UK has unexpectedly accelerated, sticking to double digits. The governor of the Bank of England confirmed that the regulator will continue to lift their interest rate. Markets expect the rate to reach 4.50% by September this year. This significant difference in the policies of the Bank of England and the Fed supports the growth of the British pound against the US dollar. In the meantime, the Bank of Japan keeps its monetary policy unchanged, thus putting pressure on the Japanese yen. However, last week the yen regained its status as a safe haven currency and won back part of its losses against the greenback. This was in part due to the banking crisis in the US that threatened to spread all over the world. Fortunately, the danger of contagion has faded away and the yen has again come under pressure. Inflation in Japan is slowly approaching the target level of 2%, while the governor of the central bank maintains its dovish stance. This means that the yen does not have many reasons for growth at the moment. The dovish rhetoric of central banks is a positive factor for gold. Lower interest rates make gold a more attractive asset for investments, but over the weekend, participants of the OPEC Plus deal announced they were planning to cut oil output further. If so, energy prices will accelerate again, which means a rise in inflation. In this scenario, central banks will be forced to resume rate hikes. Against this backdrop, gold may lose its value as investors will choose government bonds instead. So, the group of major oil-producing countries announced a production cut to around 1.16 million barrels per day. This news caused a price gap at the opening of the trading week when Brent crude was seen holding at $84 per barrel. Several signs of a possible crude shortage were recorded last week. Thus, some 400,000 barrels a day of oil exports from Iraqi Kurdistan were suspended when transported to Turkey's port of Ceyhan. At the same time, there are positive signs that energy demand is picking up in China. These are the trends of the last trading week. Stay tuned, do not miss our daily news reports and the weekly review, which is due tomorrow. See you!